You got a raise. Congratulations. Your paycheck is bigger than it was last year. The news says inflation is finally under control. The economy is stabilizing. So why does it still feel like you're losing? Why does your grocery bill keep surprising you? Why does renewing your insurance feel like opening a bad joke? Why does a weekend trip cost more than an international vacation did a few years ago? Something doesn't add up, and that's because there's a cost you're paying that almost never appears on a receipt. No one sends you a bill. No one asks you to sign a form. Congress never votes on it directly. Yet almost every American pays it, every single day. It's a hidden tax, not the kind collected by the IRS, the kind collected by time, the kind that quietly reduces what your money can actually do. And here's the strange part. It can keep taking money from you, even when inflation is considered low. Most people hear the word inflation and imagine prices exploding overnight. Gas stations changing prices every few hours, shopping carts doubling in cost. That's dramatic inflation. But that's not what quietly changes people's financial lives. The real damage often happens after the headlines disappear. When inflation falls from 9% to 3%, most people think prices are going back down. They're not. They're just rising more slowly. Imagine climbing a mountain. Yesterday you climbed 10 feet every minute. Today you climb 3. You're moving slower, but you're still climbing. Prices work the same way. A lower inflation rate doesn't mean life becomes cheaper. It simply means the cost of living is still rising, just not as fast. That sounds like a small difference. It isn't. It's the difference between expecting relief and never getting it. Think back to just a few years ago. A weekly grocery trip felt different. Fast food meals were cheaper. Used cars didn't cost almost as much as new ones. Streaming services were adding subscribers, not adding monthly fees. Today, many of those higher prices have become normal, not because companies woke up and decided to charge more forever, but because once prices move higher across an economy, they rarely travel all the way back. That's why millions of people feel confused. Economic reports celebrate lower inflation. Consumers still feel squeezed. Both statements can be true at the same time, because they're talking about two different things. One measures the speed of price increases, the other measures the price level you're actually living with. And your wallet doesn't care about perk. Now, here's where the story gets even more interesting. Most people think this hidden tax only affects people who don't earn enough money. That's not true. It affects people making $50,000. It affects people making $150,000. It affects retirees living on savings, young professionals getting promotions, small business owners, even investors. The only difference is some people notice it immediately. Others don't realize they're paying it until years later, because the hidden tax isn't designed to shock you. It's designed to blend into everyday life. $1 extra on a subscription, a smaller cereal box for the same price, higher insurance premiums, a rent increase that's only 5%, a coffee that's 50 cents more than last year. None of these changes seem life-changing on their own, but together, they quietly rewrite your budget without asking permission. And here's the uncomfortable question almost nobody asks. If inflation is only around 2 or 3%, why do so many Americans still feel like they're falling behind? Why does a higher salary sometimes feel exactly like standing still? Why does saving money seem harder than ever, even for people who are doing everything right? The answer isn't just inflation. It's something deeper, something built into how modern money works. And once you see it, you'll realize the hidden tax isn't hidden because it's complicated. It's hidden because most people are looking in the wrong place. Let's do a simple experiment. Imagine you have exactly $10,000 sitting in your bank account. You don't spend it. You don't lose it. Nobody hacks your account. 12 months later, you still have $10,000. At first glance, nothing changed. But now imagine that during that same year, the overall cost of living rose by 3%. Groceries became a little more expensive. Car insurance increased. Medical bills went up. Rent edged higher. Your favorite restaurant quietly raised its prices. Your bank balance stayed the same. Your buying power didn't. That $10,000 can now buy roughly what $9,700 could have bought a year earlier. The money didn't disappear. Its purchasing power did. And that's the hidden tax. Not because someone physically took money from your account, but because your money quietly lost part of its usefulness. Now here's where people often get confused. They hear, inflation is only 3%. Think about that for a second. If your phone battery lost 3% of its maximum capacity every year, you'd eventually notice. If your salary lost 3% of its buying power every year, the effect would be much bigger than most people expect. Because inflation compounds, just like investment returns, except instead of compounding wealth, it compounds the loss of purchasing power. A small percentage repeated year after year becomes a very big number over time. That's why someone who saved cash for decades can suddenly discover that the lifestyle those savings were supposed to fund isn't as affordable as they imagined. Now, let's make it even more personal. Imagine two coworkers. Both earn $80,000 a year. Both receive a 3% raise. They celebrate. Their paychecks are bigger, but during that same year, their overall living costs rise by 4%. Technically, they got a raise. Practically, they took a pay cut. Not because their employer reduced their salary, because their money buys less than it did before. Economists have two different words for this. Nominal income is the number on your paycheck. Real income is what that paycheck can actually buy. Your paycheck can go up, while your standard of living quietly goes down. And that's one of the biggest reasons people feel disconnected from economic headlines. The headlines report nominal numbers. Families live in real life. Now, here's another reason this hidden tax is so difficult to notice. Companies don't always raise prices directly. Sometimes they shrink the product instead. That bag of chips? A few fewer chips. The cereal box? A little lighter. The ice cream container? Not quite the same size anymore. The monthly subscription? $1 extra. The airline ticket? The fare looks cheap until the baggage fee, seat selection fee, and service fee appear. Individually, these changes seem insignificant. Together, they permanently reshape your monthly budget. And businesses aren't always doing this because they're greedy. Many are dealing with higher wages, higher transportation costs, higher insurance costs, higher borrowing costs, or more expensive raw materials. Those higher costs travel through the economy until they eventually reach you. That's why inflation isn't just one company raising prices, it's thousands of small decisions spreading through millions of transactions. But here's the twist that almost nobody talks about. If everyone is paying this hidden tax, where does the money go? Does it simply disappear, or is someone actually benefiting from the system? The answer is more complicated than most people think, because while inflation quietly erodes the value of cash, it doesn't affect every type of wealth in the same way. And that's where the gap between people starts to grow. This is where the story stops being about prices. Starts being about people. Imagine two neighbors. Both are responsible, both work hard, both save for the future, but they save in completely different ways. The first neighbor keeps most of their money in cash, a checking account, a savings account, money that feels safe because the number never goes down. The second neighbor also keeps an emergency fund, but invests the rest, maybe in a retirement account, maybe in a broad stock market index fund. Maybe they own a home with a fixed-rate mortgage. Now fast forward 10 years. Inflation averaged only a few percent a year. Nothing dramatic. No economic collapse. No hyperinflation. The first neighbor opens their bank account and sees almost the same number they expected. But that money buys far less than it would have 10 years earlier. The second neighbor also paid higher grocery bills and higher insurance premiums. But over time, many of their assets adjusted. Companies raised prices. Corporate revenues often grew. Home values in many areas increased. The value of productive assets had a chance to rise with the economy. Cash didn't. This is one reason inflation doesn't affect everyone equally. It's not simply about how much money you have. It's about where that money lives. Now that's not a guarantee. Stocks can fall. Housing markets can cool. Investments carry risk. But historically, over long periods, productive assets have often been better at keeping pace with inflation than cash alone. And that creates a quiet divide, not between rich and poor, but between money that's working and money that's standing still. There's another side to this story that surprises many people: debt. Most of us are taught that debt is always bad. Reality is more complicated. Imagine you borrowed money to buy a house with a fixed-rate mortgage. Your monthly payment stays the same, but over the years, if wages gradually rise with inflation, that fixed payment may become easier to afford relative to your income. You're paying back yesterday's loan with today's dollars, dollars that buy a little less than they used to. That's one reason moderate inflation can actually reduce the real burden of fixed-rate debt over time. But there's a limit. If inflation rises too much, lenders demand higher interest rates. Mortgages become more expensive. Credit card interest climbs. Business loans become harder to afford. Consumers borrow less. Companies invest less. The economy slows. This is why the Federal Reserve constantly walks a tightrope. Raise interest rates too much, and economic growth can stall. Keep them too low for too long, and inflation can become much harder to control. There isn't a perfect setting. Every decision has trade-offs. And that's what makes this hidden tax so difficult to eliminate. It's not the result of one bad policy, or one greedy company, or one politician. It's the byproduct of a modern economy where millions of decisions interact every single day. Energy prices, supply chains, consumer demand, government spending, business investment, interest rates, global trade. Each one nudges prices in one direction or another. So what does all this mean for you? It means the biggest financial mistake isn't simply ignoring inflation. It's assuming that low inflation means the problem is over. Because inflation is measured by the rate of change. Your life is shaped by the level of prices. Those are two very different things. When inflation slows from 8% to 3%, that's good news, but it doesn't erase the price increases that already happened. It simply means the climb has become less steep. The higher prices often become the new normal, and that's why so many people feel disconnected from the headlines. The economy can be improving while daily life still feels expensive. Both realities can exist at the same time. Maybe that's the biggest lesson hidden inside this entire story. The most powerful forces affecting your money aren't always dramatic enough to make breaking news. Sometimes they arrive one small price increase at a time. One subscription, one grocery trip, one insurance renewal, one rent increase. So the next time you hear someone say, inflation is low now, ask yourself one question. Are they talking about how fast prices are rising? Or are they talking about the prices you're actually paying? Because those two answers can be completely different, and understanding that difference may be one of the most valuable financial lessons you'll ever learn.